Welcome to the What to Watch video update. Every week I do a number of different videos. I do a video each day. I do a weekly video. Once a week I do an intermarket analysis video. I do another video that I call the deep dive video, where I go through charts that really I didn't discuss or talk about in any of the videos, just in case we get some insight from that. And then the very last video that I thought was going to be on an as needed basis, but has kind of developed into a weekly video, is called a What to Watch video. And this is what I'm focused on right now. If you've watched any of these other videos, I'm going to do it a little bit different this time, where I would have a positive list and then a negative list. It was taking so much time to create that list. I just decided to have a positive section and a negative section and then just blast right into the charts. And then I'll do my commentary and analysis as I go through that. This is being prepared for Monday, April 29th. First, we look at the positive side. The market has been going with this Goldilocks scenario that the Fed may be able to come in and cut rates because we're getting closer to that 2% inflation level. Well, that's been in question lately as we've been getting stronger than expected economic reports. But if the Fed is able to do that, they're cutting things because of the economy, they're tweaking things around and adjusting things. That's what's called a slow cycle, and that tends to be positive for stocks. If you go back in history and you look at times where that's what the Fed was doing, stock market can still go up in that kind of an environment. On the other side, if they have to come in and cut rates because of a COVID lockdown or a financial crisis or some kind of catastrophic event, that means they're reacting to something negative and they have to cut rates to try to stimulate the economy because it may be falling off a cliff. That tends to be called a fast cycle, and that's more negative for stocks. And we had been going with this idea that we were going to enter into a slow cycle. Well, that's been in real question as of late. And we're going to have a Fed meeting this upcoming week, and they're going to make their announcement. They're probably not going to change interest rates, but what they say in the announcement and then the press conference after that, and then there's a report that the market's really latched onto to try to figure out how many rate cuts there may be in 2024, that's going to be pretty critical. And if there's less than what the market was expecting as far as potential rate cuts, that could be quite negative. If they are about the same or even more, which is highly unlikely, that could be positive for the market. So we could see some real gyration on Wednesday when they actually come out and make their announcement. The meeting is Tuesday and Wednesday, and then they make their announcement at the conclusion of the meeting. Then we're also keeping an eye on sentiment. Now, a week ago when I did this video, I was putting this on the negative side because we were really going down. And that's what we tend to do. After we get to an extreme positive reading, we look at potentially going down from there, and then we just kind of ride that. Well, now we're starting to go back up. And the last few sessions, we've seen sentiment starting to pick up. So we go with that. And that's looking a little bit more positive for the time being. But this is quite volatile, and it can change really quickly. We're just looking at where we're at right now with this, and it's looking better than it was. Another thing is we're looking inside of the S&P 500. Now, I could have easily put this on the negative side because we've been going down over the last session or so with the advanced decline line based on price and volume. You know, a week ago, we were going up even though the S&P was going down. We had a really solid update, and we saw the advanced decline line actually decline in Friday's session, and that's kind of negative. But for the most part, this has been showing some improvement. We'll want to see if it can turn and start to go up if we have an update, or if it's going to continue to go down. So that's one thing I watch very closely. Another thing internally is that we're looking a little better with the new highs minus the new lows. If you look at the raw score here, you see that there's a lot higher green bar than there is a red bar. Even when we were going down, we did not see a real expansion of new lows. We saw a contraction of new highs, but this really didn't start to expand. And in fact, we're starting to see the new highs coming back in and actually getting a little stronger, enough to turn our 5-day simple moving average back positive. And we're also starting to turn up with our 10-day moving average as well. So this is more positive internally. Then we look at the advanced decline ratio. I had latched onto this because this was starting to go back up, even though we were going down. We were able to get back above zero this past week. But another thing that's kind of a warning sign is that we had a solid up day on Friday, but this ended up declining, even though it's still positive. So it's one of those in limbo kind of readings right now. We also look at the 20, 50, and 200 period moving averages. These have been showing some improvement and we're starting to go up, even as the S&P was still going down. There's another problem. We had an up day on Friday, but now we're seeing a flattening to actually declining with these moving averages. So they're looking better a little bit longer term, but more in the short term, they've turned a little bit more negative. So we want to be watching that. Then we look at the cumulative advanced decline line for the S&P, and that's not really showing all that much of an improvement based on price. We are seeing a little bit more. You notice if you compare this line going up with the line down below going up, we are seeing volume outpacing price slightly. And sometimes that can be positive. So we just want to keep an eye on that. Another thing to keep an eye on is the NYSE cumulative advanced decline line, where that is going up and showing some improvement. But when we look at the regular NYSE advanced decline line, we ticked up and we're a little bit above the moving average, but it's not really showing an awful lot of strength currently. Then this is a double and triple exponential moving average based on 20 periods. The reason why this is positive is we're actually getting above both of these lines, and both of the lines are starting to turn back up. We look at a 10-day average of the S&P 500 highs minus the lows. We had been camped at extreme positive for most of 2024. Well, we dropped down below 50 over the past week. We're seeing this coming back above 50, so that's turning a bit more positive, and that's a little longer term. And then we look at the 19-day exponential moving average of the advanced decline ratio. This is similar to that previous chart. It's red and blue. This does things a little bit more where it determines the value based on volume. But based on price, we're starting to turn back a little more positive, just barely. And we're just barely looking a little more positive based on volume, where we had been more decidedly negative. Then the parabolic SAR. This is a daily chart, and we saw some dots come underneath this past week. So the daily chart had gone from being negative, where the dots are on top, now it's looking more positive. And to me, this is a pretty influential and an indicator that I really pay attention to. We're also looking at the Ichimoku cloud. We came right down to the lower end of this cloud, and we've been bouncing up so far off of that. So this may be providing some kind of support. We look at the Eurozone stocks in Europe and compare them with 3 to 7 year bonds. This is showing a bit of an improvement. We're starting to come back up and get above all the moving averages again. And sometimes what happens in the US happens first in Europe. So maybe this is some bleed over that we might see into the US markets. Then we look at the NYSE new highs minus the new lows. We had gone negative. Now we're starting to come back and get above zero. So we're looking more positive here. The 100 period moving averages did hold. We never did quite get down to them. This is also kind of where the bottom of the Ichimoku cloud is. And we also saw some support with the mid caps that I'll point out later on. And we were able to bounce up off of that. Can we keep going from here? If we see more weakness and then we fall through these 100 period moving averages, that will turn things a lot more negative. Then the VIX is also starting to come down, where it was really going up. When it's going up, that means volatility is picking up and stocks are going down, and the momentum was positive. Now we've crossed over as the VIX has been starting to come down. The VIX usually declines when the market is more positive. Here's another chart just of the VIX. Here's a line chart which gives you closing values. We're coming down after getting some pretty high readings, but we're still right about at the moving averages. And last week, I couldn't remember this number. This is 20 right here. We did spike up above 20, but then we're able to come down and close even a week ago below 20. And this has also been declining, and we're coming back down into the moving averages. Then we look at the NYSE common stock on top based on price, where we're going up and we're seeing a little bit more strength with volume. See how this is ticking up a little bit more than the price chart? And that could be positive for the market. Now, to warn everybody, a few weeks, maybe a month or month and a half ago, I was seeing the same kind of thing, thinking, oh, this could be positive for the market. It ended up not really developing into anything. It was just something that was there for a few days, and then it went away and really didn't become all that influential. So be a little leery of this. High leverage loans. And as I've been pointing out, these are very risky loans, very high leveraged. And if the folks that are in this ETF were very concerned about economic conditions, they would be selling, not buying, and we actually bounced off of the 50-day moving average and are showing some improvement here. The long-term trend of the S&P is still positive. The blue line's above the red line. And this is a weekly chart. We haven't been able to get back above the shorter-term moving average yet. This is a 13-week moving average. But we are showing some improvement. If we could get above this and then close above this for the week, that would turn the trend even more positive. We look at the bullish percent index, where it was declining a week ago when I did this video. Now it's starting to tick back up and it's above 50. So that's turning it back to positive after it had been negative. We look at accumulation distribution. This was on the negative side a week ago where we were declining and the moving average was starting to come down. We've seen an improvement here. We're just a teeny tiny little bit above the moving average right now. But if that can continue to go up and see the red line turn back up, that would turn more positive. This indicator tries to be a smart money indicator, and it also uses volume in its calculation. So I feel it's a pretty important indicator. And we look at the summation index based on price. Now, that's not really telling us anything all that great. It's going sideways right now. But see how volume is continuing to go up? Again, doesn't necessarily mean that volume is leading price, but it can mean that as well. We've been led astray by this type of an indication before, just as much as it's actually told us that positive things will happen. So you kind of have to take it for what it's worth there. The NYSE bullish percent index is still above 50. It was coming down, ticking up, even though it was down slightly in Friday's session. We're seeing some improvement here with growth to value. This is an intraday chart of large cap growth, and that's in blue, versus large cap value, which is in red. And when we were going down, the blue line was on top. Well, then we saw a cross where even after we were bouncing, the red line was still on top. Now the blue line's been able to come back and actually overtake the red line, even though these are on different scales. That's just showing in an intraday basis that growth might be showing some improvement over value, and that tends to help the market go up. Here's an intraday chart of growth versus value for the S&P. It had really been coming down. It showed a little bit of an improvement, then some weakness. Now it's not really breaking out, but it is showing some improvement here based on where it had been. So that could be looking more positive. Then we look at small cap growth versus small cap value on an end of day chart where we're still negative, but we are bouncing back up a little bit. And the same is true with the mid cap growth to value. It's bouncing back up as well. S&P growth to value ratio on an end of day chart is also showing a little bit of an improvement. And then we look at these ETFs where we came right down to the 250 period moving average. And we were right there when I did this video a week ago. So far, we've been able to bounce up off of that. Can we keep going up inside the rainbow and eventually get back above it? If we turn and start to come down and drop below this 250 period moving average, that could turn things more negative. Discretionary to staples, and I mainly focus on the bottom area of this chart. It came right down to its 200-day moving average and is now bouncing up. Not turning positive yet, but it is showing some improvement. Then we look at the NYSE McClellan oscillator, where it's just barely positive. That's where I had it later on here in the video. It's 0.63 positive right now, but hey, it's positive. And then we look at the NYSE summation index, where we're kind of chopping more or less sideways based on price. We're ticking up just a little bit more based on volume, and this could end up being positive. We look at a thing called the Swenlin trading oscillator, and this has been going up and actually showing some real strength. Based on price, we actually got to an extreme negative reading. However, it did roll over a bit in Friday's session, so we'll be watching this. But when you take this all together, this is showing much improvement. And then we looked at some studies. The Swenlin trading oscillator and the PMO, they were developed by a gentleman named Carl Swenlin. And then he took the PMO, which is a momentum oscillator, and then built some studies out of that, where the top study is the percent of PMOs that are rising. These are inside the S&P. That has been going up, but it did fall back on Friday. The number of buy signals that are being generated is showing an improvement, and we're flattening out with the PMOs that are above zero after we had been declining. So taken together, this is showing some improvement as well. We've been looking at the staples to tech ratio. When this is going down, that means staples are underperforming, and that's more defensive. We want this ratio to go down. Sorry, I got that backwards. When this is going down, that means staples are underperforming tech, but we started to see a bounce here where staples were on a short-term basis starting to outperform tech. We want to see this ratio going back down if we're going to turn more positive on the market. When this is going back up, that means the market is turning more defensive, similar to how we did things back in 2022. With this going down, that's when we've seen some nice gains in the market. And we look at the financial sector, it's still right around its 50-day moving average, and it's still in a longer-term uptrend. So that's still hanging in there for right now. We look at a long-term weekly chart of the S&P 500 going back to the 1987 crash. We're still above that very long-term trend line. This is a blow up of that same chart just going back to 2018, also showing how we're above the trend line. And this I had on the negative side last week. Now I'm switching it back over. This is the NASDAQ 100, and then we take a ratio with the Dow. When this is going up, that means the NASDAQ 100 is outperforming, and that tends to be quite positive for the market. We were falling a little bit as the NASDAQ 100 was weak a week ago. Now it's actually starting to outperform the Dow, and we're coming back up to a really high reading. In fact, we're pretty much matching these previous highs that we set earlier on. Here's a similar look at the QQQs, which also is the NASDAQ 100, comparing them with the small caps. We're not quite at this blue line, but we're not too far below it either. And this is holding up for right now. And these are longer term trends showing us the condition of the market. Then we've been waiting to see if we're going to get a ZWAG NYSE breadth thrust. We haven't had one yet. Now, Friday was an update, but I won't get the data for this chart for Friday until after Monday. There's a one-day lag on this. If you look right here, this is April 25th. That was Thursday. We may go up, but at some point, we have 10 days after we hit an extreme negative reading, and we're still in that window for right now. But we're going to lose it if we don't get underway here pretty quick. If this gets up above the red line, that would be a ZWAG NYSE breadth thrust, which is a very rare event. However, over the last 14 months or so, we've seen 2 of them triggered. And then after that, you can see what the market did after those signals were triggered. If we can get another one, that would turn things back a lot more positive. But we're not there yet. Now we look at the negative side. When we look at the trend, and I really focus on the trend. When we're trending, I implement certain types of strategies. When we're not trending, I implement a different kind of strategy. So it's really helpful to know whether we're trending or not. And the best indicator I found is called the ADX, or average directional movement. That's the black line that you see going through here. And this can be a little confusing. And then I put a moving average, a 5-period exponential moving average on the ADX itself. When we're above, that means that the trend is strengthening. And I just use that for reference to get some context as to whether this is going up or down. We are coming down a little bit right now, but we haven't dropped below the moving average yet. If we drop below the moving average, that means it's a weakening trend. And then if we get all the way down to 20 and below, that means we're in a non-trending environment at that point. Then we take it another step and say, okay, what line's on top? Well, right now the red line's on top, even though it is declining. What we want to see to turn more positive is the green line to cross back above the red line, and then to see that trend starting to get stronger again. We're not there yet. We're showing an improvement on this chart, but we're still not quite there. Then we look at the 20-period moving averages. These are acting as overhead resistance. We have the simple moving average, that's in red. That pretty much marked the high on Friday. Can we get up above that? Until we do, we have to treat this as more negative, since this is overhead resistance. We also look at the 50-period moving averages. We're coming right up to the simple moving average based on 50 periods. Didn't quite get there, but until we can get above it and close above it, this is going to be overhead resistance. Then we look at a double and triple exponential moving average based on 50 periods, where we're not back up to the lines yet, but we did come to the underside of the triple exponential moving average. If we can break through that red line and then eventually get through the blue line, that would also turn things more to the positive side. But right now, we have to treat it as negative. This is a chart that I've been showing for months. This is a weekly chart of the S&P, and then these are pivot points. And the cool thing about pivot points, they're on here well before you even get there with price or time. So we know that this is coming. Well, we finally were able to break above this R1 level and then stay above it. Well, we broke down below it, and that turned things more negative. Now we're coming right back up to that line. Now, we actually traded above this line in Friday's session, but we ended up closing down at 5,099 and 96, which you could pretty much call 5,100. But for us to turn more positive with this chart, we want to get above R1 and then close above it for the week. And that would turn things a lot more positive. Then we have the S&P McClellan oscillator, which had gone positive, but now it's dropped back below zero. It did tick up a little bit, but we're still negative with that. And this is short to intermediate term, where the summation index, when this is above zero, the summation index is positive. When this is below zero, the summation index is negative. Those two indicators are closely related to each other. So we want to see this get up above zero for things to turn more positive. And we look at the Chaikin money flow, which is negative because it's red, but it is improving. If we could actually get to the point where we start to turn green again and this red moving average keeps going up, that would turn more positive. And this is another smart money indicator that's also based on volume. Then we're seeing a little bit of mixed signals here with our moving average studies. The 20-period moving average, after getting extreme negative, it's still looking okay. And these are stocks inside of the S&P 500. And we're looking okay with the 50-period moving average. And we actually ticked up a little bit, but we're still below 50 here. So that would still be negative, but improving. But we're actually showing a lot less of an upward move when we look at our 100-period moving average. And we actually declined with our 200-period moving average study. So we're getting a bit of mixed signals there. And we have to kind of treat that more as negative until proven otherwise. At least that's where I come out. Then the weekly chart for the parabolic SAR. Now, the daily chart has turned positive. We have dots underneath. The weekly chart continues to be negative. So longer term, we have not been able to go up enough to get a dot underneath the weekly bar. And we look at slope, which is negative, but it's extreme negative. Now, I put this red line on here, so there's nothing magical about it. I use it as a reference point. But we are starting to turn up. This is our touchiest oscillator. All of our oscillators are still negative. This is the one that tends to move the fastest. So it's showing some more improvement that we're not seeing in the other oscillators, at least yet. We're crossing above the moving average and starting to go up. If we can continue to see this going up, eventually that would help our other oscillators turn positive, and then we would go back to looking at momentum as being positive. Then we want to keep an eye on all these different moving averages. I know I broke them out in individual moving averages, but this looks kind of like a spaghetti tree here. I call it a moving average tree, where we're above the 100-period moving averages, but now we're battling with the 20 and the 50 moving averages. We want to be able to break out above all of these lines and see the lines turn back up to turn more positive. And then this is the vortex, and it's pretty simple to figure this indicator out. When the green line's on top, we're positive. When the red line's on top, we're negative. Now, we are negative because the red line's on top, but it is declining. If we could see the green line show more improvement and actually cross back above the red line, then this indicator would turn back to positive. And then this is an indicator that I developed decades ago for a trading system. I don't do that trading system anymore, but I kept the indicator. Very simply put, this is a 20-period simple moving average of the open, high, low, and the close. And this produces its own little mini rainbow. And when we're above this and we pull back, oftentimes one of these lines may provide support. We broke below it and we're coming back up. We haven't been able to get above this rainbow yet. So these lines are now acting as resistance until proven otherwise. So this is looking still more negative. Then we're looking at the momentum of the NASDAQ 100 using the PPO, the price percent price oscillator, price percent oscillator, whatever. It's PPO, where it continues to be negative. We're below the moving average, but we are trying to turn back up, and we're also still below zero. So we're getting kind of a deep reading from this oscillator. If we could cross above the moving average and then go back above zero, that would turn the NASDAQ 100 momentum back to positive. Look at the mid caps where we came right down to this pivot point. And the only thing I could think of is this was also about where the 100-period moving average was for the S&P and also the bottom end of the Ichimoku cloud. And the mid caps had been stronger. They're not stronger right now, but they've been holding up a little better as we were going down. And so maybe the market took a cue off of the mid caps and we're able to use this as support to bounce higher. Now, this chart is still negative, though, because we're below the 50-day moving average. The long-term trend is still positive, but we want to get back above this red line to look even more positive. Then we look at the Amex, NASDAQ, and NYSE, and we take a 5-period moving average of the highs minus the lows. We're still below zero. We are improving. We had been seeing a lot more negative readings, but we're still negative nonetheless. And we look at a ratio between the S&P and utilities. When this is going up, the S&P is usually going up. Well, this has been going down, even though it bounced up a little bit on Friday. We want to see this turn and really start to move up with more conviction to turn more positive. And then here's the bullish percent index for the NASDAQ 100. It is improving. When I showed this a week ago, we were way down here at the bottom. So it is bouncing up and it's no longer extreme. It's still negative because we're still below 50. So it is improving, but it would turn back to positive if we could get back above 50. The long-term chart here of large cap growth, we have to treat this as negative. Even though the 100 period moving averages, they acted as support a couple of times, not only a week ago, but then after Thursday, we're still not above the 50 period moving average here. That's acting as overhead resistance. To turn back more positive, we want to, and this is a daily chart, we want to see this get above and then close above that 50 period moving average. Mega cap growth, still in a longer term uptrend, falling below its moving average based on 50 periods, showing some improvement, but still below that 50 period moving average. The Wilshire also in a longer term uptrend, but still below its 50-day moving average. Total stocks also still below its 50-day moving average. The FANG index is right up to its 50-day moving average, so that's still acting as overhead resistance. The tech sector is bouncing back up. It still has a ways to go to get to its 50-day moving average. And the semiconductors are just underneath its 50-day moving average. So we're seeing some improvement across the board, but we still have some major overhead resistance across a lot of different indexes and sectors. The QQQs, this is more negative. The 20 crossed below the 50, and we're coming back up to the 50-day, the 20-day moving average. If we can get back above both of these lines, that would turn things more positive. But longer term, we're still in an uptrend. And then we look at riskier bonds versus more conservative bonds. When this is going up, and riskier bonds you may know as junk bonds, and that means folks are willing to take on the risk to get more of a yield, more of a return on that investment. And when we're in a rising interest rate environment, we tend to see folks getting into that. And when this is going up right now anyway, in a rising interest rate environment, that would be seen more as negative. And we saw that going up as interest rates are going up. What we want to see to turn more positive is, according to interest rates, is this ratio starting to come down, meaning that conservative bonds, where they lock in longer rates that are safer bonds, folks are tending to prefer those. And if that was to happen, then we would see this start to decline, but we're not seeing that yet. We're looking at the 10-year yield where we're continuing to go up. We're not back to 5% yet where we were back in October, but we have been trending higher as far as the 10-year yield, and that can really pressure stocks if we continue to see interest rates go up. We look at 1 to 3 month T-bills, which you could pretty much call cash, and compare them to 3 to 7 year bonds. What I'm focusing on right now is this is going up. That means there's uncertainty about interest rates. There's also uncertainty about inflation. And this just means that cash is outperforming 3 to 7 year bonds. You'd be better off just hanging on to your money right now. And that's what we see when we look at this ratio. And then we look at the tech sector and compare it to 3 to 7 year bonds where it had been pulling back. It came down into the rainbow. It's showing some improvement now, but we want to see this look even better and get up outside of the rainbow. And then we look at 1 to 3 month bonds and compare them with 3 to 7 year bonds. When this is going up, that means folks are preferring shorter term bonds because they're afraid that interest rates are going to go up. And when that bond matures, they can roll it over into a higher interest rate. When this starts to come down, like we saw in October and into November, that means that folks think interest rates have topped out, and now they're getting into longer term bonds that they can ride for a while, because they think that interest rates are as high as they're going to be. Well, that's what the market was thinking, but now it's had to shift back over to this other line of thinking, and this ratio continues to go up. And then we're still looking at the idea of a soft landing. This is the S&P on here. I know I don't have a little note on here, a label. We were really pulling back. We were coming down into the rainbow. And what this looks at is the SPY with 3 to 7 year bonds. And when this is going up, that means the market is anticipating a soft landing. And that's pretty much what was happening. It doesn't go straight up, but that was starting to come into doubt. Well, over the past week, this showed some improvement, and now we're starting to go back up more into the rainbow. If this really starts to collapse, then that's when the market will be anticipating a hard landing or a recession in this case. We look at the QQQs and also compare them with 3 to 7 year bonds. They were pulling back with this ratio, but now it's starting to show some more improvement as folks are willing to go more risk on and get into the NASDAQ 100 stocks. Then we look at TIPS, which are very short term. They're Treasury inflation protected securities. We compare them with further out bonds, 7 to 10 years. When this is going up, that means folks are nervous about interest rates and inflation. Well, it was coming down, but now it's starting to go back up. And so this just means that inflation and interest rates are a real concern to the market right now. And we look at home construction. I showed this a week ago where we were really coming down. We're seeing some improvement with this chart, but it's still looking more negative until we can get back above the rainbow. And we look at a ratio between staples and the S&P. When this is going down, that gives support for the S&P to go up. This really spiked up, even though it's coming down now. We want to see this continue to fall to turn more positive with this chart. And we look at a long-term weekly chart of the NASDAQ 100, we're still just a little bit below this long-term trend line. We came almost up to the underside, so we are improving, but we're still just a little bit below it. Then the dollar, which is continuing to hold up, it's been chopping sideways over the last few sessions. We got up into the 106 range, and now we've fallen back into the high 105s. If the dollar keeps going up, that often puts pressure on stocks. Thank you. I really hope you found this helpful. If you want to hear about updates with all these different charts that I've been going through, please tune in to the daily videos, since I'll be going through all the things that I talked about in this video. I hope you have a very good weekend, and I will talk to you in the next video.